happy to respond to them if time permits. With that, I would like to hand over the call to Mr. Manoj Raghavan. Over to you, Manoj.
Thank you, Shashank. A very good evening to everyone. Thank you all for joining us this evening for the earnings call. We are happy to report a healthy operating revenue growth of 17.1% year-on-year in the current macroeconomic environment, while delivering an EBITDA margin of 29.6%. In constant currency terms, our revenue grew by 1.2% quarter-on-quarter and 11.9% year-on-year. During the quarter, our healthcare and life sciences business reported a healthy quarter-on-quarter growth of 3.2% in constant currency terms, which is a significant improvement over the performance during the earlier two quarters. This vertical also reported new product development deal wins for medical diagnostics and smart hospital equipment. In the transportation business, we continue to see good traction and a strong deal pipeline, especially in software-defined vehicles and electric vehicles. The transportation business grew by 1.8% quarter-on-quarter and 17% year-on-year in constant currency terms. While some deal closures were delayed in this quarter, we won new deals, including a strategic multi-million-dollar SDV deal with a leading Asian OEM for the SDV platform and software development. We also won a multi-currency licensing and deployment of a connected vehicle platform deal with a global top 5 OEM. Media and communication business performed creditably to retain and grow market share, even though absolute revenue growth was muted. The quarter-on-quarter revenue growth was at 0.2% in constant currency terms. We won our first multi-year deal for our 5G network orchestration and automation suite with a leading telecom operator. This is an important milestone for the renewed portfolio we are building for this industry vertical. However, the media, telecom, and technology sector is still soft globally, and we remain cautious on the short-term growth in the sector, while staying close to our key customers and focusing on intelligent AI-powered solutions and technologies that will drive the next wave of transformation in this industry. I am delighted by the all-round customer excellence demonstrated by Elxsians that has allowed us to grow strongly with our key customers and position us well for competitive differentiation and new project considerations around our customer base. Our successes in growing our business with our large accounts resulted in the share of revenue from our top 5 accounts increasing from 39.8% in the previous quarter to 42% in the first quarter of FY24. Similarly, our revenue share from top 10 accounts grew from 49.4% in Q4 of the previous financial year to 51.9% in Q1 of this financial year. On the people front, we continue to invest in a talent base with a net add of 422 Elxsians in this quarter. The Elxsi family is now 12,000 plus strong, with attrition dropping further to 15.6%. We have driven strong operational excellence across the organization and protected our EBITDA margins despite wage hikes and strong employee additions in the quarter. Our effective tax rate in this quarter has increased on account of lower tax exemption due to the completion of 5 years for a couple of SEZ units, impacting our PAT margins. Our PAT margin for the quarter stood at 21.6%. It's a matter of great pride for all of us at Tata Elxsi to partner with ISRO and play a role in We wish ISRO the very best as it progresses further in the ambitious human space flight mission. As we step into the second quarter of this financial year, the confidence of our customers in our differentiated design digital proposition and delivery excellence and a strong deal pipeline, especially in automotive, healthcare, and design businesses, provide us the confidence and foundation for accelerating our growth throughout the year. With this, I will hand over the floor to Shashank for the Q&A session.
Shashank, before you go, this is Nitin Pai here. I have a brief update for the entire audience who's joining us today. We moved to a new fact sheet format, and my apologies because I think we missed the reporting the constant currency growth for the overall company. The intent, of course, was to move to a new format to make it more readable, more user-friendly, but I believe that we had a lapse on that front. that will be corrected. So you will continue to see the constant currency report at the company level too. So my bad on that. Thanks.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Bhavik Mehta from JP Morgan. Please go ahead.
Thank you. Couple of questions. Firstly, Manoj, on the transportation vertical, obviously you mentioned that the deal closures were delayed, but have you also seen deal conversions getting pushed out, because of the macro and, clients being a bit cautious? So, because the growth has been a bit soft over the last 2 quarters in a row now. So, what's the outlook over there going forward? And secondly, to Gaurav, if you can give us the margin walk for this quarter and, are the wage hikes completely done in 1Q, or can we expect some part of the wage hikes to come into Q1? Thank you.
Sure. Regarding the transportation business, yes, you're right. I think some of the deals, closure is taking time, and but however, I think the deal pipeline is still pretty strong. There are large opportunities that we are chasing, and we are really hopeful that we will have those closures in Q2 and the subsequent quarters. To that extent, I think that lack of conversion is really reflecting in the sort of soft revenue growth. But I think we're pretty confident that come Q2 and Q3 we will see accelerated pipeline closures. Gaurav?
Yeah, hi Bhavik. On the margin, our EBITDA is 20 basis points lower compared to the last quarter, in spite of the wage hike that has been rolled out during the quarter for the significant amount of the Tata Elxsi employees. In terms of the brief margin walk, we have an impact of 140 basis points from the salary hikes plus the piece of cost that we have taken for a month in this quarter, because as we mentioned in the last quarter that we went ahead and we got an approval for the employee stock option plan, so that has been rolled out and communicated to the employee in this quarter. Their cost for 1 month has come in, so including both wage hike and the piece of the impact is about 140 basis points. We continue to reduce our contractors since we have better bench strength and the trained campus is available to us, so that provides us a leverage of about 40 to 50 basis points to do that reduction and roll over from the TPC contractors to our own employees. We have an exchange movement gain of about 20 odd basis points onto the margin walk, and another 50 basis points coming from the other operating leverage in terms of the pyramid rationalizations and improvement in the utilizations with the volume growth and the scale. So that makes a total of 20 basis point impact on a quarter to quarter sequential basis on our operating margins.
Thank you, that's very helpful.
Thank you. Participants, you may press star and one to ask the question. Next question is from the line of Vimal Gohil from Alchemy Capital. Please go ahead.
Yes, sir. Thank you for the opportunity. My question is again on automotive. Sir, how should we see that performance in the last 2 quarters versus what we are experiencing and reading about in the overall automotive industry? Given the fact that most of the OEMs are, and of course tier 1, tier 2 suppliers are also talking of areas where we are heavily invested in. These are high growth areas, and there is an urgency of investments over there being spoken about by our potential and existing customers. So how should we reconcile our relatively softer performance there, and what gives us the confidence that Q2 should be much better? Is it all related to macro? Because macro clearly tells us that things are moving probably faster than what we expected in the automotive space, especially. Thanks.
Yeah, I think I've answered that question. I mean, just to repeat, right? So the deal pipeline is pretty strong. We still have pretty large opportunities that we have placed bids on, and what is supposed to be closed in early part of Q1 is still open. So customers are definitely taking their time to, especially on large bids and so on. So I think it is natural given the current macroeconomic situation. Customers are being careful before they roll out, especially the large deals and so on. So I think the fact that we have a good pipeline and we see closures happening in Q2. That's the discussion we've had with a number of our customers. We really hope that that additional revenues will kick in Q2. So that's the confidence that we have.
Understood. And sir, within broadcast and comms, have we essentially bottomed out, or still things will continue to remain soft for the entire year? And lastly, just one point on transportation as well. Given our last 2 quarters of performance, do we expect FY24 growth rates in transportation to be lower than what we had in, let's say, 23? Would that be a fair assessment? Yeah, thanks. That's all from my side.
No, we wouldn't want to call out anything at this point in time, given that we are only in the Q1 of the financial year. I think we would definitely want to wait and see, at least a quarter or more, right, to make that sort of a conclusion. But we still remain, pretty confident that, we are on a good wicket as far as our transportation or automotive business is. Regarding the media and communication business, it's not just us; it's the entire industry that you see multiple of our competition has also shown either degrowth or significant degrowth in that business. Thankfully for us, we have held our ground, even though we have not grown significantly. But I think we have done a very good, creditable effort to maintain our business where it is. And especially if you look at our top 5, top 10 customers, I think we've actually even won deals and improved our market share as compared to our competition. So I think, but having said that, the industry is still media and communication industry is still pretty soft. I wouldn't want to call it a washout for the full financial year. I think we would want to wait and watch and see how Q2, how the deal closures happen in Q2, and then take a call on how the industry is.
Thank you, sir, and wishing you all the very best.
Thank you.
Thank you. Participants, you may press star and 1 to ask the question. The next question is from the line of Anika Mittal from Invest Analytics. Please go ahead.
Hello. Good evening, sir. Am I audible? Hello.
Yeah, you are.
Okay. Sir, my question is from the healthcare segment side. So what is your near-term outlook on this particular segment for FY24?
I think, over the last 2 quarters, we've had some, I think the healthcare and life sciences business did not show, the growth that we were expecting, but I'm happy to, and I think that is also because of the transition in the Euro MDR, activities, and that has taken us a couple of quarters to get over that. But I think this quarter we've demonstrated good, new deals and good product, wins there. So that has really helped us to show a good growth. We are pretty optimistic that we will be able to show this continued growth in the subsequent quarters also. But I will not be able to give you a number for the financial year. We don't give that predictions. But I think we are on the recovery path, and we hope to grow back to our earlier growth rates in this business pretty soon.
That's it from my side. So thank you.
Thank you. Next question is from the line of Bhavik Mehta from JP Morgan. Please go ahead.
Thank you once again. Sort of just on the margin bit, is wage hikes done for last part of the employees, or should we expect some wage hikes to come in 2Q as well? And secondly, your net employee addition has seen an uptick this quarter. How should we read that? I mean, is this a sign of improving demand you see going forward, or is this a way to optimize the cost by reducing the dependence on subcontractor, and hence, you want your own employees to be utilized more on the projects?
Yeah, so I'll answer that. So I think we have gone, wage hikes in Q1 for all our junior staff. I think almost 70% of the headcount we have given the wage hikes. For the senior staff, the wage hikes would come in this quarter from July 1st onwards, right? So the new hires that we have been doing, I think it's something that we continue to do, looking at we're not looking at a quarter-on-quarter basis to really squeeze the hiring. These are offers that we have made, and we continue to honor all the offers that we have made. We strongly believe that we need to build our resource pipeline for the future quarters, and I think this is an ongoing. I mean, we're not really diluting that focus of stopping hiring and so on. We continue to hire at our normal rate. That's also the
OEMs going from a product to a solution side. A lot of them are now trying to sell SaaS solutions. So my question really was, how do you guys see all of this integration into the global master, let's say, bus going ahead? Because it seems to me that the market is just not having a lot of standardization. And then if you have a brake supplier, if you have a battery supplier, if you have an engine component producer doing their own solutions, how easy or difficult it is to integrate all of these in a digital stack and then give this out as a package, if you will, to an OEM client.
Hi, Satadru. This is Nitin Pai here. Maybe I'll take that. On one hand, if you look at software-defined vehicles, I think it's fundamentally driven by OEMs, and it has been driven precisely with that point in mind, which is that ultimately the car is an amalgamation of software, hardware, and mechanical elements coming from thousands of suppliers. And a lot of these are black boxes, and therefore, if you're trying to drive performance out of all of those, if you're trying to speeden up or create agility out of how you update functionality and features in the car, you not only have to work with, again, the same thousands of suppliers, but each of those changes cost you money, and each of those changes require you to go through a full validation and certification cycle. So to that extent, I think the premise of SDV itself is exactly that there are two opportunities. One, the opportunity to create agility in the features and functionality of the vehicle, both what is going to be delivered and produced newly, but also what is available already in the field through software updates. So that's part one. And I think part two, which is more interesting, is equally the monetization opportunity. That now that you have a connection to the consumer directly, which was otherwise not available to OEMs, they were only connected through dealers. It's only dealers who had a relationship. So does that relationship now create opportunities to monetize? And that monetization can take completely different paths, right? From subscription-based features to over-the-top services that you can deliver, and so on and so forth. So I think the point remains that software-defined vehicles are here to stay. The level of software-defined is always a question. I'll just call it software-centric. Because different OEMs will require and can afford different levels of ownership. In some cases, it may not even be necessary to try and own everything. You may just choose to take a selective view on what software you own and what software you run. But I think the premise is very clear: agility and monetization. So that's, I think, a one-way street. You will see that change. So I hope I have kind of addressed what you wanted to understand.
Yes, absolutely. That's very helpful. A similar sort of question on the healthcare and life sciences space. I was sort of trying to read up the balance sheets of a few, let's say, global medical device companies. For some reason, the last 2-3 quarters have been very choppy for them. I mean, the pharma companies are struggling, but the med devices are struggling even more. I just had a very generic question on how do you guys see is the lucrativeness of this space going ahead? Because I know that gross profit margins are high, and I know that there are a lot of software definitions happening in the med devices space, a lot of connected devices, IoT, and then running analytics on top. So just give me a sense of how do you see the overall market getting better or worse, and how are you guys planning to play in this market, basically setting up yourself for the future?
Sure, sir. This is Nitin again, so I'll take that. If you look at the premise on which we are, and which we in fact even built to focus around the medical devices and healthcare industry, it was based on the fundamental presumption that in general the healthcare industry has been fairly conservative. Product life cycles are very, very long. In fact, there are devices that were designed 15, 20, 25 years back that continue to run. And the advent of cloud, AI, connected devices essentially means that you can actually afford to deliver a far more superior customer experience, far more data-led insights that directly affect patient outcomes and health. And therefore, it is essential that all products actually pivot to, in some sense, the equivalent of the car. You need to be connected, you need to be automated, I'll not call it autonomous, and you definitely need to look at electronification, because a lot of the previous generation medical devices were electromechanical rather than electronics. So that's the premise on which we've built the business, and you'll see that over the last 5 years, from the time we started, we moved from zero revenue to about 15%, right? And that's been a business that's grown almost 10% quarter on quarter for a few years to go. So to that extent, I think there is confidence that an industry is actually behind the automotive industry in terms of the transition that it needs to make, even though there are no regulations that are driving it, unlike in the automotive industry where you have sustainability, you have ESG concerns that are put stakes in the ground as far as countries are concerned. This is really an opportunity to change, because that is what will sell in the future. That is what will create monetization in the future. So to that extent, I think there is great confidence that that pivot has to continue. Software, cloud, IoT, connected devices, intelligence. That is an inexorable path for medical devices. All of them have to get there. The pharma industry has to adopt it to some extent too, in the sense that as pharma industry moves from prescription-based billing to outcome-based billing, you will need to then monitor patient vitals. You will need to provide for patient tracking and so on. All these are devices that will do it, because the drugs will be then decided based on the markers, and that will be personalized based on the actual patient profile. So in our view, I think the fundamentals of electronics and software becoming the dominant part of what medical devices companies need to do is a given. The rate that we'll do it at is not driven at the same rate as automotive, because automotive has priorities coming from regulatory and regional or country-based decisions that have been made on when they will stop or turn off ICE and so on. The medical device industry does not have that trigger, but it has a trigger of how do I make money in the future. So that is what creates absolute confidence, and I think we're just at the start of that. We know it's a conservative industry. It's difficult to get in. There are barriers of entry, but we have a marquee set of logos that we work with. We are quite confident of our ability to stay incredibly relevant to these companies.
Very helpful.
Yes.
Maybe just one last question from my side. This is, let's say, a mix of talent management / the sectors that you guys play in. It always fascinates me how a company can play in these three diverse EPD verticals and still be successful. I know the broad-based argument that if one sector doesn't go good, then you can diversify and so on and so forth. But, if I look at a company, if I look at the big outsourcing players, the Accentures, the Capgeminis, or even your big brother like TCS, so for them that makes sense. But I'm always curious how you guys think of talent, because these three are so diverse verticals that, let's say, the domain knowledge is very different, the software standards are so different. So apart from the fact that, of course, you can have some basic level of integration, how do you guys just, manage talent and just see these three very diverse verticals sustaining? Because I'll be very frank, I haven't seen another company like Tata Elxsi doing so diverse verticals and still having so great returns over so many years. So how do you guys look at talent management and these three diverse verticals in general?
Sure, Sutadru. So, Nitin, again, just like Coke or KFC, I'm not going to reveal all our secrets. But having said that, maybe I'll start with the fundamental point, right? That when you have been doing this for 25 years and more, and this is the only business that you do, believe me, there's a whole lot of ingrained company knowledge that reflects in its processes, in its quality systems, in the way we both hire and manage talent. So that's the first fundamental building block that we build on. Equally, we also acknowledge the fact that these three industries are so different that the domain knowledge, especially as you move quickly up the seniority and experience levels, demands that you have training programs, you have training methodologies, you have quality systems, you have everything that is different for each of these verticals. And to our advantage, I think that's also a core competency. That's also what makes it very difficult for a generic IT player who depend on fungibility, who depend on training that is industrialized. I mean, you would have trainings that people take just for 15 days, 1 month, and then they're ready for billing. For us, it's nowhere close to that. For us, it's multiples of that timeline to get people ready. But I think that's the way we do business, and hopefully that's the secret sauce that we bring.
Very helpful. Thank you, gentlemen, and all the very best.
Thank you. Take care.
Thank you. Next question is from the line of Chirag from Ashika Institutional Equities. Please go ahead.
Hi, sir. I want to understand, whatever the development is happening in the India across the sector, like EMS, defense, automotive, and rail, and etc. And the order bidding is going to the global players, which are some of them are our clients. So I want to understand our relationship with them. That how we going to benefit by taking orders from the global OEMs, which are fueling the growth of the Indian economy for the diverse sectors. Yeah.
Yeah, maybe I can take that. Very quick view is we definitely have, and this is for multiple sectors, whether it's automotive or whether it is rail and agencies, where there are programs that are won by suppliers or suppliers to supply to OEMs in India or to programs in India, including rail. We find that we are supporting those programs, and our relevance becomes even higher, especially if you're competing with regional or overseas-based competition. So to that extent, the fact that we are in India, we bring proximity, understanding of those customers, ease of communication, ease of coordination, I think only adds to our attractiveness. But please note, having said that, any program in India obviously comes at cost equations that are quite different from, let's say, doing the same project for a deal in Spain or a deal in the US and so on. So you also have to live with that challenge, which is that you will have that much more of a pressure on the pricing and the deal value. So it's a conscious balance that we have to strike in terms of what is right for us, what is relevant, and despite the fact that we can win almost anything that we bid for.
Okay. And how is the supply side scenario situation in Europe and the USA for manpower and other related stuff?
Yeah, I think as you know, we are 90% of our resources are based in India. It's only 10% that are based overseas. So to that extent, I think we are less dependent on resources in the overseas market. Having said that, I think the resource situation definitely has become a lot more easier. We are able to hire resources on need basis. But in general, as Gaurav said, we are reducing the dependency on third party contractors and filling positions using our own internal resources for better margins and so on. Right? So that we will continue that approach.
Okay, thank you so much, sir, and all the very best.
Thank you.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from Akshay Ramani from Axis Capital. Please go ahead.
Hi, thanks for taking my question. So, first question for Manoj. You said that the deal pipeline gives you the confidence of growth acceleration going through FY24. Now, this is despite another comment of a soft media and communications, at least in the near term. So, just want to understand that is the strength of transportation and medical enough to power that growth acceleration going forward? And while you're talking about demand, if you can also talk about how do you see the IDV business going forward?
Sure. So I think, yes, as I said, growth has come back in our medical business, and we definitely hope that we will see some acceleration in our transportation business, moving forward. Media and communication, we are still hopeful, though it's very difficult to give a comment in terms of, how much of recovery will happen. But definitely, as compared to a lot of our peers and other global players, we still continue to deliver value to our customers and at least not degrow in that, media and communication business. So that's something that we will, constantly keep a watch on. Regarding the industrial design business, as I said, it's a smaller business. It's a very, very critical business for us. With that business also has grown as compared to last financial year. It has grown significantly. But however, on a quarter-to-quarter basis, we see some amount of, either flatness or some amount of ups and downs. It's still in the early stages to see how we can, have a steady quarter-on-quarter growth there. But that's something that we are working on. We definitely are hopeful that, the industrial design business will also continue to grow significantly, over the next 3 quarters for the financial year. So I think all of that gives us a confidence that in spite of the media and communication business being a little soft, the other businesses that we have should definitely be able to continue the growth path and essentially help us to show a decent growth in the financial year.
Right. So on IDV business, over the past 2 quarters, we've seen a flattish performance. So is this more to do with standalone IDV customers, or is it some EPD vertical specific customers where we have seen some softness on the IDV side?
It is a combination of both, right? IDV also does a lot of work for the media and communication business. So that part of the business is a little slow, as similar to what our EPD business is. And but however, IDV also have their own independent customers, and then we are really focusing on that to see how we can grow that business.
Got it. Our next question is for Gaurav. So, Gaurav, you talked about 1 month of ESOP cost impacting this quarter. When I look at the release shows that about 40 lakh of ESOP cost was recognized in Q1. So even for 1 month, that number appears quite low. So if you can please help me understand this quarter's ESOP expenses and how do you see the sustainable cost which we should think about going forward?
The first month the cost is low. It depends upon the number of the grants unit that has been communicated to the employees. There is still some communication which is left to be done, which will be done in the quarter 2. Hence, what we talked about in the previous quarter earning call also, that going forward, the impact for the PSOP grants once done completely to all the employees would be about 0.4% to 0.5%.
Got it. And since we have also rolled out the wage hikes for the rest 30% employees, so what kind of margin impact would that have in Q2?
So we have not yet. We are still in the process of working out rate hikes and the impact for the remaining employees, which will happen effective quarter 2. But I think with the scale and the growth that we expect to have in the quarter, in the next quarter also, we don't see any significant impact. But yes, there will be some wage hike impact. But at the same time, we feel that can be, compensated with the other operating leverage and the growth in the volumes, total volumes.
Got it. And then coming to the utilization part, so if you can just touch upon what level of utilization are we operating at and what's the sustainable level which you think is good for the company? Thanks.
I think currently we are operating 72.5% is the utilization. Yes, I think that is also because of the fact that a number of fresh engineers that we have hired have come out of their training period and now they are on the bench, right? So the good part for us is we have a pretty good bench strength now. So as the business picks up, all the training investments and all the hiring investments that we have put in, we'll be able to use them and grow our revenues. So for us, we would be really comfortable, to see how we can push this utilization from 72 or 72.5% over a period of time to somewhere closer to 80% or so, right? So that will be something we are aiming for, and so as you see, we have enough headroom and leeway to utilize these trained resources, and that's something that we will focus on in the next few quarters.
Thanks for answering my questions.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Nathan Gupta, individual investor. Please go ahead. Nathan Gupta, may I unmute your line? Yeah, go ahead.
Am I audible?
Yes, you are.
My question is with respect to the hiring that is planned for.
Nathan, sorry, but we are losing your audio in between.
Hello. Is it better now?
Yes.
Yeah, my question is with respect to the hiring of, what are the plans for the complete financial year?
So for the complete financial year, if you look at hiring of freshers, we would be hiring around anywhere between 1,800 to 2,000 engineers, of course, depending on the joining ratios and so on. Lateral hiring will be always need-based, based on specific projects or engagements. But given the fact that we have enough bench strength, I think we will first focus on utilizing the bench strength before going out and hiring laterals.
Okay, thank you for that. And the last question would be can we expect this kind of margin going ahead for the full financial year?
We don't give margin guidelines, and you must look at our track record over the last 8 to 12 quarters, right? You will get the answers for your question.
Okay, that would be it for my side. Thank you.
Thank you. Next question is from the line of Rajat Kumar, individual investor. Please go ahead.
Yeah. Good evening. Just 2-3 macro questions I have. The first one is on the ADAS technology. So I just want to know, given that we are part of the Tata Group, so how do we make insights with other vendors? Given our exposure to JLR and others. So I just want to competition with Samsung. They are better placed compared to Tata Elxsi. So how do we overcome this?
Yeah, so maybe I'll take that. Technically, we don't compete with Samsung. We are a potential supplier to Samsung. Right? And when you say Samsung, I presume you mean it in the context of Harman, which is the acquired in the group. So to that extent, Harman would be a potential customer. It is a customer rather than a competitor. So in that sense, there is no conflict of interest. And it's not to do with whether we work with Tata Motors or JLR or not. The question is, do we have capabilities on the software side that add to what they are trying to do in terms of product engineering and product development? And to that extent, we're incredibly relevant.
Okay, got it. Yeah. And second thing, are we developing any robots, linked to the Da Vinci, more on the medical side? because I've seen his website, it talks about the industrial robotics. So just want to know what work we are doing on the medical side.
Yeah, so there is automation. I'll not call it fully robotized surgery or fully automated surgery, but there is a fair amount of work that we're doing both with AI as well as robotics that are to do with automating and bringing in precision surgery. But at this time, that is all that I can tell you.
Okay. Because currently that is the only US FDA approved robotic system, right? So
that's right. So to that extent, that's why I'm hesitant to say that we are working with fully robotized systems. But there is some level of automation and precision surgery that happens in multiple other spaces. I mean, think about eye care, for example. You will see that there are laser-guided surgeries that work on cataracts and so on. So it's not that there is no robotic surgery in other areas. If you look at cancer, there is equally guided robotic treatments that happen for chemo, radiation, and so on. So all I would encourage you to look at is the fact that robotics and automation applies in many levels. Just like in cars, you have from level 1 to level 5.
Okay. No, my question is more from a strategic standpoint. So like in a 3 to 5 year standpoint, will we be challenging Da Vinci systems? That's what.
Oh, no. So please note, again, like we made the comment on Samsung and so on, we would hope that we would work with Da Vinci and create more Da Vincis by supporting them.
Okay, got it. Sir, and lastly, how about the opportunity from the in-flight entertainment system, given that Air India is now part of the Tata Group, and there's a lot of things happening on the aviation here. So are we going to leverage any of this and get more work on this space?
In-flight entertainment is a very niche area, and I think there is just a couple of companies that work on it, and so the opportunity is not very big in that sense. But however, as you rightly said, Air India definitely is a group company, and there are a lot of other opportunities that we are working with Air India and supporting them, not necessarily on the in-flight entertainment. But yes, if there is an opportunity, definitely we would definitely get involved, because we bring in enough competencies on audio, video, the play out, the entire video capabilities that we have in the media and communication business is fully relevant to this use case. But then there are definitely a lot of regulation, safety, and number of standards that we need to understand. So to that extent, yes, the opportunity is not as big to really focus and go after that, and the number of players are also very, very limited. But we are in discussions with Air India for a lot of other opportunities, and we will leverage that Air India to see what we can do in the avionics or airline industry.
Okay. Yeah. Thanks a lot, sir. Thanks for answering questions.
Thank you. Next question is from the line of Rohan Nagpal from Helios Capital. Please go ahead.
Thanks for the follow-up. You break out your vertical exposure for the embedded product design segment, and you briefly touched on the vertical exposure for the IDV segment. Could you flesh out the vertical exposure in the IDV and SI segments as well?
IDV definitely, I think about 3 to 4 years ago, IDV had its own set of customers and they used to go around, but we consciously took a decision to focus IDV capabilities around the same 3 verticals that we have, which is transportation, media and communication, and healthcare. So today, if you ask me, a majority of our revenues in the IDV space come from these 3 verticals. Of course, there are a number of other verticals that we go after that EPD doesn't service, right? So yes, so there is a lot of effort and focus that we've brought in, including from a sales perspective to really cross-sell IDV into all our EPD customers, right? So that's something that we continue. SI is a totally different business. SI is primarily business based out of India. We provide system integration services to a different set of customers, not necessarily the three verticals. And that's something I think we would be a little more opportunistic and of course even in SI what we're trying to do is to see how we can leverage SI capabilities to address the three verticals in EPD. It's at an early stage. IDV has progressed a lot, but SI is still a very early stage. And however, and especially on the as we look at building our own products and so on, SI plays a very, very key role on the run management part, right? And that's something, especially on the cloud and data center and so on, that is where we intend to use their capabilities. But again, as I said, it is still a pretty early stage there.
You got it. Thank you.
I'll just add one comment. At this time, the fact that IDV is a little volatile, it's not exactly a constant number quarter on quarter, does not allow us to publish a mix because you will not read very much from it. I think if you give us a few quarters, and that's something that you're consciously deciding, we'll be able to draw a clear signature to say, okay, this much percentage you can trust to come from automotive, this much you can trust to come from media, and we have a certain amount of sustainability or rather lack of volatility that makes it meaningful to publish the breakdown. So I'll just
that's helpful.
Yeah.
That's helpful. Thank you.
Thank you very much. Ladies and gentlemen, we'll take the last question from the line of Satadru Chakraborty from Chakraborty Family Office. Please go ahead.
Yes, thank you. Just one final follow-up question, and maybe feel free to answer it as you see fit or not. This is really around the IP of Tata Technologies, which is coming out. So maybe my preliminary observation is very bad, but I do see there are a lot of similarities. I mean, from the very quantitative stuff I have seen, there are related party transactions happen in 21 and 22. Just help me understand why should we treat it as two different companies and what is really the strategic differentiation within the Tata organization that we have to really differentiate between the two. And I know the history and the corporate structure and Tata Motors wants to spin this off, but just what is your 2 cents on this, what an external investor looks at?
Yeah, so as you rightly pointed out, Tata Technologies is a subsidiary of Tata Motors, right? And they also have a significant portion of their revenues coming in from group companies, which is Tata Motors and JLR and so on. And they primarily play in the, if you ask me, I would say the mechanical engineering space. They have some, they do work on ERP, which is SAP and so on. And recently they have built capabilities in the avionics industry with Airbus and so on, right? So that is what Tata Technologies stands for. Tata Elxsi, on the other hand, is a full-fledged, product engineering. Majority of our business comes on electronics and embedded software domain, and we work across. 3 different verticals, right? Automotive, healthcare, and media and communication. So to that extent, if you look at it, if you look at the automotive industry, it might seem as if there is a clash or a conflict situation, but actually we are pretty orthogonal, and the service offerings are pretty orthogonal. So there are customer places where we work together and provide services and solutions to the customer. So to that extent, I would say we definitely can continue to coexist as 2 different companies.
All right. Thank you.
Thank you.
Thank you very much. And I'll hand the conference over to the management for closing comments.
Yeah, thank you all for taking the time out for this Q1 conference call. We definitely hope to see you again in the Q2 conference, and definitely there is a lot of commitment from our side, from our employees to ensure that we deliver good results in the coming quarters, right? So that's something that we are very much aware of, and we continue to pursue these large strategic deals that will really help to show consistent quarter-on-quarter growth, and that's something that definitely we will stay focused on. Thank you so much once again, and look forward to seeing you again next quarter.
Thank you very much. On behalf of Tata Elxsi Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.